Hello guys, this is Lily and welcome back to my channel. In today's video we are going to talk about how to make passive income and how to build the most efficient high dividend yield portfolio. Before we begin, I wanted to thank you for supporting my channel. Thank you for your likes and comments. Watch this video till the very end and I promise it will be a lot of interesting stuff in the end. This video will help you to understand the value of investing and how to make passive income. Also, before we go further, I want to give you a fair disclosure that I am not a financial advisor and I am not representing any companies or investment products I will be describing in this video. This video was created to help you to understand the concept of passive investing. Please choose your strategies very carefully. I will help you to answer following questions in a very simple and informative way. What is passive income and how to pick the right portfolio? What stocks, ETFs or mutual funds to look for? Can you make passive income on crypto? And what platform to choose to start investing in? So let's go. Passive income can be a great way to help you generate extra cash flow whenever you are running a side hustle or just trying to get a little extra each month. Passive income can help you earn more during the good times and tide you over if you suddenly become unemployed or even if you voluntarily take time away from work. With passive income, you can have money coming in even as you pursue your primary job, or if you are able to build up a solid stream of passive income. You might want to kick back a little. Either way, a passive income gives you extra security. And if you are worried about being able to save enough of your earnings to meet your retirement goals, building wealth through passive income is a strategy that might appeal to you too. So what is passive income? Passive income includes regular earnings from a source other than employer or a contractor. The IRS says passive income can come from two sources: a rental property or a business in which one does not actively participate, such as being paid book royalties or stock dividends. Many people think that passive income is about getting something for nothing. It has a get-rich-quick appeal, but in the end it still involves work. You just give the work up front. In practice, you may do some of all of the work up front, but passive income often involves some additional labor along the way too. You may have to keep your product updated or your rental property well maintained in order to keep the passive dollars flowing or the dividend portfolio up to date and not to lose track of the performance and just let it sit. In any way, it requires due diligence from your end. But if you are committed to the strategy, it can be a great way to generate income and you will create some extra financial security for yourself along the way. I would like to specify what passive is not. Passive income is not your job. Generally, passive income is not income that comes from something you've been materially involved in, such as the wages you earn from a job. Passive income is about creating a consistent stream of income without you having to do a lot of work to get it. Non-income producing assets. Investing can be a great way to generate passive income, but only if the assets you own pay dividends or interest. Non-dividend paying stocks or assets like cryptocurrencies may be exciting, but they won't earn you passive income, and it applies. I look at the passive income to be more independent from your primary 9-to-5 job. So let's deep dive in what is the easiest and safest way to start building your passive income strategy. A dividend yield stock portfolio is one of the most attractive ways to build a dividend and income producing portfolio. There are plenty of well-established public corporations with a decent amount of dividend payout and a good track record history. For stocks like AT&T, ExxonMobil, Energy Transfer, Verizon, and Coca-Cola, the average return on this would vary from 6 to 7% a year. Let's review AT&T for example. What is AT&T? It is a well-known, well-established telecommunication company. This sector of the economy calls utilities. Historically, utilities considered is one of the safest harbors for high dividend stocks. The companies have a safe income stream from their subscribers. This sector includes internet service providers, water companies, gas, electricity. So for AT&T, the average dividend payout ratio is $2.8 for the price of the stock at today's date of $22.94. Let's calculate the dividend yield. We take the yearly dividend and divide it by our purchase price. In this case, it's $22.94, and it equals to 9.06%. Not bad. Meaning that if we had 100 stocks, which we only would spend $2,294 on, we would get on average $208 in a year dividends as passive income on your brokerage account. But of course, the dividends may vary and may be completely excluded from the distribution. What could be the reason? Company performance? Let's say that last quarter the company missed the earning goals or lost the market share due to some issues within the company or from outside sources such as regulators, mergers and acquisitions, which may be some natural events. Companies may say that we will not be paying any dividends or we will pay fewer dividends as were expected by investors. For these reasons, it is important to look at the dividend payout history of the company and see if we ever missed it. In our example, AT&T never missed a dividend payment for the last 30 years. But of course, the dividend varied, and as you can see from this data, some years it goes higher, some years it goes lower. If you feel it's too much to review each individual stock, you can look at the whole stock portfolio, such as VIG, Vanguard Dividend Appreciation ETF, or VYM, Vanguard High Dividend Yield Index. The dividend yield, however, will be way lower. However, this ETF provides some more growth and diversification and safety for your overall portfolio. What are other options? Do they exist? The answer is yes. The next highly attractive way to look at the REITs, Real Estate Investment Trust. A real estate investment trust is a company that owns, operates, or finances income-generating real estate. Modeled after mutual funds, REITs pool the capital of numerous investors. This makes it possible for individual investors to earn dividends from real estate investments without having to buy, manage, or finance any properties themselves. You can also buy REIT on the stock exchange, and they trade on spot as a regular stock. The dividend rate is also very attractive and can vary from 5 to 15%, sometimes 20%. So how to choose the one that is great? By picking a good rate, you can apply the same concept. Research, calculate the dividend yield, and look at the dividend payout ratio. After COVID happened, I look at the REITs as a risky type of investment due to many government moratoriums and eviction restrictions. Many real estate properties could stay for a long time without generating any extra income due to their tenants would not be paying rent. Also, the migrating shift and tendency to work remotely caused some of the REITs to revise their management strategy and look further for more investment opportunities. Some of my favorites are NLY, ARCT, and PSCC, none of which ever missed the dividend payment on my history. The average yield is about 10%, but during the first week of COVID, when everything plunged, I was able to purchase both NLY and ARCC at the bottom and secure a 23% yield on both rates based on the current dividend payout amount. These are three main concepts of building passive income on your brokerage account. In the next video, I will show you how to build passive income with crypto, real estate, and other projects that won't take way too much of your time down the road. Thank you very much. Please stay tuned for the second chapter of this video. Like and subscribe and comment down below. Stay safe. See you soon.